All right, this is about going a little deeper into the market relationship pillar of this approach that everyone is going into and learning through the edge. It's showing now the ability to take what you already know and start applying it to looking at charts and looking at price ladders, this compare-contrast technique. Then we're going to go to a sketch pad where I'm just going to illustrate what these comps look like. We're going to compare lows to lows of different markets, highs to highs, and then introduce the IMD signal, which stands for intermarket divergence. So let's compare and contrast like everyone is used to doing. As you learned in the first two tracks, what do you do when you shop for a car? You compare dealerships to different dealerships to find value, right? That's a common technique. The advent of the internet has brought all that information to the consumer's fingertips. You don't go into the dealership with a chart and start to negotiate based on Fibonacci levels or moving averages or any kind of technical tools that too many people in this industry, the retail audience, uses to value price. You go in and you compare dealerships to dealerships. You know that they're cheap or expensive based on that comp, right? So how do we do that when you're looking at price ladders or, for this example, charts? When you compare one chart to another, we're going to go to what I call a sketch pad just to go and illustrate market A and market B. It could be any two markets that relate for obvious reasons, okay? We could use the NASDAQ versus the S&P E-minis, two futures that are both stock indexes. It makes sense that they're going to chart similarly, right? They're both representing U.S. stock indexes. So when we go and we look at and say, what are we looking at? How are we going to compare? I know how to compare a dealership to another dealership, but how am I going to compare a market to a market on a chart? And what we're looking to do is compare lows and highs for starters. So for instance, if this market A over here has a chart pattern like this, and market B relates to it, it's going to have a similar chart pattern like that as well, correct? Where you could say that this low was put in at the same time that this low was put in, right? And the markets are trading similarly because they're similar markets. What if, however, this one rallies and goes up and then just rotates down to here, and market A rotates up and sells off down to there? This low, which is the same as this low, was breached by market A. If I were to draw a line through that low, you could see the penetration that market A had through that price. However, looking over at market B, it's maybe several ticks away from going through that low. That's an intermarket divergence. Let's look at the same example only on highs. All right, and we're just looking at highs and lows for now. Market A rallies up, puts in a high, then retraces lower. Market B does the same thing, puts in a high, retraces lower. Market B tries to rally back up. Market A does rally back up and goes through what was the old high. So market A makes a higher high. However, market B cannot breach those highs. It's a real simplistic way to say that one market could be expensive, market A, and market B could be showing you weakness. It starts to pull in, how do I execute a bias? And what's most important, what we're going to continue to drill down on, is executing a bias and then being able to change it. Well, this is a really, really invaluable lesson because now you could start to use markets that relate to each other to your benefit to create a healthier bias, but then also execute a bias that you might have for some other reason in this divergence environment. We're going to show a couple images of real charts to get a sense of what this looks like on real charts. If you look at the left, that's the NASDAQ futures or the NQ. On the right is the S&P minis or the ES. What we try to do here at The Edge is continue to show in repetition what this looks like, not just with images, but also real time, right? Recreating a prop firm environment where you're reviewing markets and being able to look for things in real time and review as to whether or not you caught that, right? Did you see that the S&Ps were making lows or making highs and the rest of the market wasn't? So let's just look at these two images on the highs, and I'll introduce the IMD signal or intermarket divergence signal. If you look here, you've got a market that is making highs right in here inside that circle. That's the NQ. That's the same high as this price over here. On the right, the S&P minis. You could see the S&Ps go down and then try to re-rally, right? They actually re-rally through that old high. And the intermarket divergence signal says, but the NQ is not making highs. So let's take a look at the NQ here on the left. The NQ makes that high in the circle, sells off, tries to re-rally, and doesn't breach that high at that particular moment. And the IMD indicator says, but the ES is making highs. The signal allows you not necessarily to get short and sell and execute, but begin to raise your eyebrows and make you aware of what these correlations are doing. And it's not just the NASDAQ compared to the ES. It could be several different correlations that you look at and say, well, why wouldn't the S&Ps make highs with the NASDAQ or vice versa? So that's important to kind of understand. Now, going back, you could look at even another example of this divergence, and you could say, here's another instance where the market made a high in there, same high that this guy is here in the ES. Both markets dramatically sold off, re-rallied. S&Ps made higher highs, did the NASDAQ. And you come over here and you could see that while the ES made a higher high, the NQ did not. Another example, an instance where you would see the IMD kind of signal and make you aware that this divergence was taking place. And I think that's what's important now here at The Edge, is to get people to start to look at these markets through a different prism that most were looking through before you came in to this community. You're looking at charts as references and not staring at them, but you're getting good references. And now, just like you would pull up on an internet website that compared different dealerships to each other, now you're pulling up different charts to compare different markets that often relate. And in instances where they don't relate is that head scratch moment. I want to go back to a sketch pad just to kind of walk you through an inverted relationship. We talked earlier about the relationship often between stocks and bonds. And it's also written in the text of the course about the asset allocation between these two markets. So, for example, when bonds go down typically, that means you got individual investors selling out of bonds. And what do they do with that capital? They usually reallocate it into stocks. And so you'd get a rally in stocks or stock indexes when bond market prices sold off. So that's the logic behind that inverted relationship. So what would that look like with highs and lows? And let's just take these two lines that are already drawn in there. Let's say the bonds are going down and keep making lower lows through these levels, right? They look like a downtrend. They keep going down. And with every move down in the bonds, the S&P or the stock indexes also rally. But at some moment, the bonds take a leg lower, and this time the S&Ps can't go up. And when you get that instance where they were working and they were opposite, and now they're not, has to be one of those head scratch moments. You know, you have to say they were opposite through that whole move, through that whole sequence, but they're not right now. Begins to allow this professional prism that we're looking through to execute the right way, to execute with intermarket relationships instead of squiggly lines on a chart, to execute with confidence because of the interconnectedness that this business has with these markets. Your market awareness will exponentially uptick when you start looking at relationships. And what's important about the community that we're putting together at the Edge is that different relationships come in and out of importance. Sometimes stocks and bonds is a great relationship. Other times the asset allocation environment isn't it isn't realistic anymore. It's not privy to what's going on. There's no fear in the market, so it's no longer of value. But then different correlations between individual stocks and the stock index it belongs to. For example, if you're a NASDAQ trader and you don't know what Apple and Google are doing, then you're not a NASDAQ trader. You have to be aware of what ancillary or stocks inside that index are doing that often drive the index. So different relationships are important at different times, and being in the right community of people who work at saying, hey, take a look at XYZ, it's driving the S&Ps. Don't look at the asset allocation right now between stocks and bonds because they're moving the same way because of central bank interaction. That's what a professional environment is all about, and that's how you start using these relationships as we drill down and get deeper into executing and creating a bias all in one.